Welcome to The Explainer. Today, we're breaking down the real battleground of trading, the one that happens inside your own head. Look, it's not about finding some magic indicator. It's about forging a disciplined mind. Because in the world of trading, the first person you need to conquer is yourself. So many traders are on this endless hunt for that perfect, secret strategy, thinking it's the key to unlocking success. But the truth, as the experts at Smart Risk put it so well, is much, much closer to home. The real challenge, the real missing piece of the puzzle, it's all about emotional discipline. And get this number is pretty startling. It's estimated that a whopping 90% of traders really struggle to find consistent profits. And it's not because their charts are wrong. It's because their own psychology is actively working against them. It's just a huge reminder that this isn't just a game of analysis. It's a game of mindset. Okay, so let's dig into this. Why is it that a trade that looks perfect on paper, a trade you've researched for hours, can still go so wrong? The answer almost always comes down to one single thing: emotion. I mean, think about it for a second. Chasing a trade you missed because of that classic fear of missing out. Or what about revenge trading? Trying to claw back money after a frustrating loss. Or maybe going way too big on a setup that just looks perfect. These aren't logical decisions, right? They're emotional reactions, and just one of them can wipe out weeks of hard-earned, disciplined progress. So the big question is, how do we actually fight back against these emotional impulses that are so hardwired into us? Well, you need a toolkit. So let's dive into some really actionable rules that can basically build a firewall between your emotions and your trading account. Okay, so these several rules here put together by the psychology experts at Smart Risk are basically the foundation for a professional approach. Now look, we can't break down all 7 today, but we're going to zero in on a couple of the most critical ones that can have an immediate impact on your trading, making your rules non-subjective and mastering your risk management. And this is where things get really interesting. See, a subjective rule like enter on a long wick, what does that even mean? In the heat of the moment, when your money is on the line, you can convince yourself of pretty much anything. But a non-subjective, rules-based signal, it's pure math. It is a simple yes or no question, and that leaves absolutely no room for emotion to creep in and mess things up. And this right here perfectly illustrates one of the absolute golden rules: risk management. A core principle is to only risk a small, comfortable percentage of your capital, say 2%, on any single trade. So why do this? It's simple. It makes any single loss psychologically, insignificant. You can't get all emotional about a loss that doesn't really hurt you. It's what keeps you in the game long term. All right, so building on that idea of risk control, let's talk about managing the trade once you're actually in it. This technique here is just fantastic for taking the pressure off. By locking in some profit and moving your stop to break even, you make it literally impossible to lose money on the trade. You completely kill that nagging fear of a winning trade suddenly turning into a loser, and that frees you up mentally to hold on for those bigger moves. Okay, but here's the catch. Even if you have the most perfect set of rules, you still have to fight your own brain. Our minds are actually hardwired with these cognitive biases that are actively working against our success in the markets. I bet this sounds familiar to you. You're in a winning trade, you get a little profit, you get scared it's going to disappear, so you grab it, only to watch the thing run for hundreds more points without you. But then, on a losing trade, you'll hold on and on, just hoping it'll come back, even as it digs a deeper and deeper hole in your account. This isn't just you. This is a well-documented psychological phenomenon. Yeah, it was actually coined way back in 1985. It's called the disposition effect, and it's one of the most studied biases in behavioral finance. And it's all driven by 2 really powerful emotions: the desire to lock in the pride of being right, of having a win, and this deep-seated aversion to admitting we were wrong, which is what realizing a loss feels like. And the data on this? It's crystal clear. There was this landmark study back in '98 by a guy named Terence Sodine. He looked at 10,000 brokerage accounts and found that, on average, an investor was almost 60% more likely to sell a stock that was up in value than one that was down. It's like we're hardwired to cut our flowers and water our weeds. Just incredible. Okay, so you've got your rules to fight your emotions. You know about these biases like the disposition effect. The next logical step, of course, is to backtest your rules to see if they work, right? But what if the very tool you use to build confidence, the backtest, is actually its own kind of psychological trap? Now, I know this looks a little complex, but the main takeaway is actually super simple. A massive study analyzed 888 different trading algorithms, and what they found was wild. The things we love to chase in a backtest, like a super high Sharpe ratio, which is just a measure of return versus risk, well, it turns out they have almost zero power to predict what's going to happen in the real world. You can see how scattered the dots are on the left. But look at the right. The risk metrics, like how volatile a strategy is, were incredibly consistent. So what's the key takeaway here? A backtest is awesome at telling you how bumpy the ride might be, but it's a terrible predictor of whether you'll actually get to your destination. And this chart right here, it just perfectly captures the danger of what's called overfitting. The study found a direct relationship. The more a trader tweaked their strategy to get that perfect-looking backtest, the worse it actually performed in the real world. They hadn't really discovered some timeless market edge. They'd just gotten really, really good at memorizing the answers to an old test. So, okay, if we can't really trust these simple backtest metrics, then how on earth are we supposed to build any real confidence in a strategy? Well, the answer seems to be moving away from simple metrics and towards a much more sophisticated, data-driven process. Well, the way forward, which is really inspired by modern AI-driven trading, it isn't about chasing one single magic number. It's about looking at a strategy the way a doctor examines a patient, assessing dozens of factors altogether. Instead of just asking, how profitable was it? This approach asks, how did it behave? It looks at everything from its risk profile to its position concentration, and you get a much, much more reliable diagnosis of its overall health. And look, here's the proof in the pudding. In that same study of 888 algorithms, the researchers had an AI classifier select a portfolio of strategies. The portfolio picked by the AI, that's the one in green, it consistently and significantly outperformed both random portfolios and, this is the important part, portfolios chosen using the old school method of just picking the highest backtest Sharpe ratio. So what's the big takeaway from all of this? The hunt for a perfect predictive signal is, more often than not, just an illusion. Real, lasting success in trading comes from having a disciplined process, a robust risk management plan, and a deep, honest understanding of your own psychology. The data is just so clear on this. A solid process will always, always be a hunt for the perfect prediction. So I'll leave you with this question. What is the one rule we talked about today that you are going to commit to following starting right now?